If you want to understand how a war makes some investors rich, do not begin with the war, begin with the spring. That is the image I want in your head. Not a battlefield, not a map, not a headline crawling across a red television banner, a compressed steel spring. Because that is what a real crisis does to markets. It does not simply destroy value, it compresses it. It forces good assets, weak assets, liquid assets, stupid assets, cyclical assets, and misunderstood assets into the same frightened pile for a while. And then the people who understand what will release the spring get paid in a way everyone else later calls obvious, but it is never obvious in the middle. That is the first lesson. I have lived long enough to know that the great fortunes made during crisis periods rarely come from predicting the first explosion. They come from understanding the second move. The first move is always loud. Oil spikes, stocks fall, anchors start talking too fast. Safe havens sometimes even fall with everything else because forced selling does not stop to ask whether an asset deserves respect. The second move is quieter at first and much more profitable. The second move is policy. That is what most people miss. They think the war is the event. The war is not the event. The war is the compression. The event is the panic in policy circles once the economic damage becomes clear enough that governments and central banks are forced to respond. That is where the spring lives. And if you do not understand that, then every crisis looks like the same movie: fear selling, retreat, maybe some gold, maybe some oil, maybe hide in cash and wait until the television says the danger is over. That is how ordinary people think. It is not how serious capital thinks. Serious capital asks different questions. What is already overbought because the crowd rushed there first? What is being sold not because its long-term value broke, but because everything is being sold? What is structurally impaired by the shock? And what is merely being marked down by the shock? What policy response becomes most likely if the pain lasts another month or two? And when that policy response comes, what assets have the most compressed spring under them? That is the whole game. The public sees panic, the prepared investor sees a spring. Now let me tell you why this matters so much in the present situation. The source material is superficially about the U.S.-Iran war, oil, the Strait of Hormuz, and a sharp market correction. Fine, those are the headlines. But the thing I care about underneath all of that is the shift already visible in the bond market. That is the real signal. Oil can scream one story while bonds quietly whisper another. And the whisper is often the one that matters more for the next 6 months of your life. The whisper right now is simple. The market is beginning to fear recession more than inflation. That is the decisive change. I want to explain that carefully because it is the hinge on which the whole spring turns. When a war first erupts and oil surges, investors do the obvious arithmetic. Energy costs rise. Inflation looks hotter. The central bank looks less likely to cut. Risk assets wobble. Gold can behave strangely because forced liquidation does not care about theories. The first reaction is chaotic because everybody is looking at the immediate hit. Then the market begins asking a better question. What if oil is now so high that the economic damage from the oil shock itself becomes larger than the inflation story the oil first created? That is when the movie changes. This is one of the oldest and most important transitions in macro investing. When the market crosses from fearing an inflation extension to fearing a growth break, the asset winners change completely. That is why I say war does not make all investors rich. It makes a very particular set of investors rich. The ones who understand the transition from inflation panic to policy panic. That is the real map. I think most people still use the wrong map because they stop at the commodity spike. They see oil at 115, they see headlines about disruption, they see falling stocks, and they conclude this is just a broad risk-off environment where safety lies in whatever has not yet gone down enough to frighten them. That is a beginner-s reading. The adult reading is harder. A war shock can be inflationary first and recessionary second, and once the market starts believing the second part matters more than the first, the entire opportunity set changes. That is where I want to build the framework. The first mechanism is what I call the oil ceiling. The oil ceiling is the point at which higher oil stops being merely an inflation problem and becomes an economic break. So severe that recession risk begins outranking inflation risk in the market's mind. Most investors never think carefully enough about this moment. They hear higher oil and mechanically say, bad for bonds, bad for rate cuts, bad for anything sensitive to easier money. That is true only for a while. Above a certain level, expensive oil starts acting like a tax, large enough to damage demand, business confidence, consumer behavior, and forward growth expectations. It is not just a price input anymore. It becomes a recession accelerant. That is the oil ceiling. Once the market senses that oil is high enough to begin breaking growth rather than merely heating prices, it starts looking through the inflation shock toward the next policy response. That is how the spring gets compressed. Assets that were sold because the inflation scare looked dominant can suddenly become the very assets that rip higher when the market realizes the next move is policy support, not further tightening. This is why bond yields matter so much in the current setup. If oil is surging and long yields are not exploding higher in the old clean way, or worse from a consensus perspective, they begin easing. That is not noise. It is the market telling you the inflation story is being overtaken by the recession story. That is the signal serious money follows. It is not the television oil graphic, it is the bond market's refusal to keep reading the war as a pure inflation event. That is why I keep saying you must start with the spring. The spring is being compressed by fear, but the force inside it comes from the market's changing interpretation of what policy must eventually do. Now let me name the second mechanism. I call it the policy panic. A lot of people hear that phrase and imagine a dramatic emergency press conference with some official confessing that the world is in terrible shape. That is not how policy panic usually appears. Policy panic is rarely honest enough to name itself. It usually appears as one of three things. D. Escalation that suddenly removes part of the oil premium and causes money to race back into rate-sensitive assets. Central bank support that is not called a bailout but works like one. Government coordination that signals liquidity, fiscal cushioning, or emergency stabilization in a way that tells the market, we cannot allow this to keep tightening. That is policy panic. It is not the public language of fear. It is the official behavior of institutions that have realized the system is more fragile than they can comfortably admit. This is one of the great differences between novice and experienced investors. Novices think in headlines, experienced investors think in likely institutional reactions. The novice asks, how bad is the war? The adult asks, how much pain will policymakers tolerate before they begin trying to cushion it? That is the better question because markets reprice on the answer before the public feels safe again. This is why so many fortunes are made in the middle of ugly conditions. The investor making money is not cheerful. He is simply one step ahead on the policy sequence. He knows that if enough damage accumulates, someone powerful will try to stop the bleeding. And when that attempt begins, the assets most brutally oversold during the fear window often become the ones with the sharpest spring-loaded reversals. This is what the source material is really trying to say when it talks about the next 30 to 60 days. I agree with the underlying logic, though I would frame it differently. That critical window is not a magical because the calendar says so. It is critical because the spring is usually most mispriced in the period where fear has already wrecked sentiment. But policy still has not fully revealed its hand. That is the sweet spot. Too early and you are buying into raw compression without a clear release mechanism. Too late and the release is already priced. This is why I think timing matters here more than usual. Not because exact bottoms matter, but because the spring itself does not stay compressed forever once enough catalysts line up. Now I want to name the third mechanism. I call it the false refuge. This is where I think many ordinary investors get punished. They buy what has already spiked because their minds are still living in the first phase of the crisis. Oil producers' defense names already surged on the obvious war trade. The problem is not that those businesses are bad. The problem is that the spring is already partly released in those areas. If you arrive after the crowd into the obvious beneficiary, you are not capturing compression, you are paying for consensus. That is the most expensive thing in markets. Consensus, the public nearly always confuses correctness with opportunity. Those are not the same thing. You can be correct that a war benefits certain oil producers and still lose money buying them after the move is already crowded. The price you pay determines whether your right idea becomes a right investment. I have always believed that the best crisis trades are not the obvious first-order beneficiaries everyone can name after 1 week of headlines. They are the second-order beneficiaries of the policy turn that follows the first-order shock. That is where the spring still hides. That is where institutional notes become interesting, because the real value is not in hearing that war matters. Anyone with a pulse can hear that. The real value is in understanding which assets are temporarily repriced by sentiment and which are structurally impaired by the shock itself. This is the difference between buying a compressed spring and buying a broken thing. Now let me name the fourth mechanism. I call it the damage split. Every crisis hurts assets in two completely different ways. Some assets are structurally damaged, some are sentiment damaged. The job is to know which is which. An airline facing much higher fuel costs, pressured demand, and fragile margins is structurally damaged by an oil shock. An overleveraged company that needs cheap refinancing in a world suddenly less willing to provide it may be structurally damaged. A business whose supply chain depends directly on the disrupted channel may be structurally damaged. That is real damage. But a software business serving secular AI build-out demand, with little direct oil sensitivity and no dependence on Middle Eastern shipping routes, can still get sold hard in a general liquidation, because fear is broad and managers sell what they can, not always what deserves it. That is sentiment damage. A strong consumer franchise in a domestic market can get priced as if the customer disappears forever, when in reality the business is merely passing through a fear window, while the market reprices every discretionary name as if depression were imminent. That is sentiment damage. A gold miner can trade below the logic of its margin leverage because retail has not yet arrived at the right phase of the gold story, and broad liquidation has not fully finished. That is sentiment damage. The damage split is one of the most valuable concepts in all of crisis investing. It teaches you that falling price does not tell you enough. You must ask why it is falling. If it is falling because the earnings power itself is truly impaired and likely to remain impaired, caution is warranted. If it is falling because a broad sentiment wave is repricing everything in sight while the long-term engine remains intact, that is where wealth gets built. This is why I prefer to buy the temporarily mispriced rather than the obviously fashionable. The fashionable are almost always crowded. The mispriced are where the spring lives. Now let me name the fifth mechanism. I call it the toll road trade. This is where one of the best opportunities in the current setup sits, not in the commodity producer everyone can already see, but in the infrastructure that gets paid for movement pipelines, storage terminals, export infrastructure, LNG facilities. The system that collects a toll, whether a barrel is beloved or hated, expensive or less expensive, as long as it moves. I have loved toll roads my entire life. Real toll roads, economic toll roads, businesses that sit in the middle of activity and get paid for passage. They are not glamorous enough for the average person's imagination, which is precisely why they are usually better than the glamorous trade. The commodity can be noisy. The toll road is steadier. When a crisis rearranges supply routes, rebuilds flows, forces diversification of transport, and redirects energy movement, the toll road often becomes more valuable in a way the crowd does not fully appreciate at first. That is why I find energy infrastructure more interesting than simply chasing the already spiking producer story. The producer is a direct war trade. The toll road is a structural repricing trade tied to how the world adapts to the war's disruptions. That adaptation often lasts far longer than the emotional life of the headlines. This is where I want to say something important about patience. The best crisis positions often feel less exciting than the headlines that inspired them. That is good excitement is where retail arrives. Structure is where money stays. Now let me name the sixth mechanism. I call it the Oversold Spring. This is where consumer discretionary, software, and other beaten down assets enter the story. I know that sounds strange to people still trapped inside the first phase of the crisis. They hear war, oil spike, falling confidence, weak sentiment, and they think restaurants, travel, retail, software, or consumer finance must be exactly what you avoid. That is often true at the first instant. It is not always true at the policy. Panic threshold. If the market has already driven those assets into valuations that imply a far more durable impairment than likely reality. And if the next major shift is a policy easing of conditions rather than a further tightening, then those are often the very places where the spring is most violently compressed. This is the counterintuitive beauty of crisis investing. The things everyone is too frightened to own near the bottom of a panic often become the most rewarding things to have owned. Once the panic turns, not the obvious winners, the over-discounted survivors. That is the oversold spring. The important word there is survivors. I am not telling you to buy wreckage. I am telling you to identify what has been sold far beyond the damage it is likely to suffer. That is not easy. It requires discrimination. It requires balance sheet analysis. It requires asking whether the business model needs cheap capital every quarter to survive or whether it merely needs time for sentiment to heal. That is where maturity matters. A great many young or reckless investors hear oversold and think cheap. Those are not synonyms. Something can be oversold and still be terminal. Something can be down 40% and still be too expensive. The spring is not in every broken thing. It is in every too cheap survivor. That is the difference. Now let me name the seventh mechanism, because none of the others matter if you fail here. I call it the leverage purge. Leverage is what turns right ideas into bad outcomes. A war shock can continue longer than you want. An oversold market can become more oversold. A policy response can arrive later than your broker's patience. This is why the people who make the greatest crisis fortunes are almost never the most leveraged. They are the ones who can hold. That sounds simple. It is profound. The person with no leverage, enough liquidity, and a clear framework can survive the last ugly leg of a correction and still own the assets when the spring releases. The person with leverage may be exactly right about the sequence and still be destroyed because the market reached his pain threshold before it reached his thesis horizon. I have seen this too many times to count. Brilliant idea, wrong capital structure, dead investor. That is what leverage does. It steals your timing flexibility in crises. Timing flexibility is worth more than cleverness. So before any of the opportunities I am describing can matter, the leverage must be removed or at least reduced to a level where further volatility does not force surrender. No one gets rich from the right thesis if the position cannot survive the path. That is the whole point of the leverage purge. Now, once you understand these 7 mechanisms together, the whole environment becomes much clearer. The oil ceiling tells you why recession begins to outrank inflation once the shock gets large enough. The policy panic tells you what kind of release mechanism the market starts pricing. The false refuge warns you away from chasing what already spiked. The damage split tells you what is broken versus what is merely sold. The toll road trade shows you where structural beneficiaries sit upstream of the obvious crowd trade. The oversold spring identifies the sectors most likely to snap back when policy turns. And the leverage purge reminds you that surviving the path matters more than sounding brilliant about the destination. That is the framework. Now let me tell you how I would actually think if I were sitting with my own capital in front of this setup. First, I would stop asking where the final bottom is. That is one of the most childish obsessions in all of investing. Bottom picking is for people who want narrative closure more than returns. What matters is not whether the market can still fall another 5 or 7%. What matters is whether you can identify the right compressed springs before the policy release makes them obvious to everybody. That is the adult question. Second, I would distinguish between tactical stress and strategic impairment. This is just another way of saying the damage split matters more than the headline count of daily red candles. A business that survives and keeps its long-term engine intact is not the same thing as a business whose economics are genuinely being broken by the shock. Third, I would favor structures that benefit from the response, not merely from the conflict. That is why I prefer the toll roads, the oversold rate, sensitive survivors, the secular software names with intact demand, the beaten discretionary assets at historical valuation extremes, and selected consumer finance exposures that can benefit when the rate story begins easing. Fourth, I would keep one eye constantly on the real triggers. Any credible de-escalation signal, any coordinated policy package, any central bank move that eases financial conditions without using the word cut. Any yield move that confirms recession is fully taking over the narrative from inflation. Those are the spring release signals. This is what the crowd will notice too late. They will wait for certainty. They always do. By the time certainty arrives, the spring is already halfway gone. Now let me say something that may sound cold, but it is the truth. The war will make some investors rich, not because war is good, not because destruction is somehow morally desirable, but because all large crises create windows where policy, fear, valuation, and forced selling briefly pull certain assets far away from their long-term realities. That distance is what generates the return. You are not profiting from suffering in some cartoon villain sense. You are profiting from mispricing. That is the correct word. Mispricing born of panic and then corrected by policy. That is how crises transfer wealth from the frightened to the prepared. This is also why I dislike the phrase, buy the dip, when used lazily. Most dips are not worth buying just because they exist. A real crisis demands more seriousness. You must know the mechanism, you must know why the spring is compressed, you must know what event is likely to release it, and you must know whether the thing you own deserves to survive that release better than the market currently assumes. That is far more sophisticated than chanting a slogan into a falling chart. Now I want to end where I began with the spring because I think that image explains everything better than the headlines do. The war is the force pushing downward. Fear is the hand holding it there. Policy panic is the moment the hand starts to lose control. And the assets that rise hardest are not the ones the crowd first pointed at on day one of the war. They are the ones carrying the most compressed energy when policy finally starts to turn. That is the secret. That is why some investors get rich. Not because they are braver, not because they have private notes from banks, not because they can predict the exact day the strait reopens or the exact sentence the Fed will choose. They get rich because they understand the spring before the hand lets go. That is where I would rather stand. Not in the crowd buying what already spiked, not in the crowd frozen by red screens, standing beside the spring, watching the policy hand ready for the release. That is how the U.S.-Iran war will make some investors rich. And if you have followed the framework carefully enough to know where the real springs are, then you now understand how